Late Friday, after the markets closed, Standard & Poor's lowered the U.S. credit rating from AAA to AA plus status. The U.S. has held the top AAA rating for more than 70 years. Not only did the S&P issue a downgrade, but the report included a warning of future downgrades. The outlook on the long-term rating is negative. We could lower the long-term rating to AA within the next 2 years if we see that less reduction in spending than agreed to, higher interest rates, or new fiscal pressures during the period result in a higher general government debt trajectory than we currently assume in our base case. That was the S&P notes to the report. Economists, politicians, and pundits immediately debated the extent to which the reduced rating will have an impact on the U.S. economy. I caught up earlier with one of our best respected experts on these financial issues, Bob Williams of Delta Trust Investments. Well, Bob, what is your take on the downgrade of U.S. creditworthiness by Standard & Poor's?
I think it's a function of the dysfunctionality of Congress. S&P had been threatening to do this if there weren't $4 trillion in budget cuts as part of the budget deal that was recently cut and the debt ceiling. And we didn't reach anywhere near that number, and they're concerned on our ability to do that. They're concerned about the state of the economy and the fact that we probably don't have enough stimulus to create jobs right now.
And we've seen some other credit agencies pause at this juncture. Do you see them following Standard & Poor's lead and also downgrading the U.S. credit rating?
Actually, no. The two other rating agencies have affirmed the AAA rating at this point, and we don't expect the others to follow. This, again, I think was more a commentary on the political state of our country than the economic state to some degree.
What do you think the chances are that this S&P downgrade will trickle down to the consumer, to the average small business owner? What do you think they're going to see, if anything?
I really don't know that there's going to be a lot. We've seen the markets have already pretty well factored in and expected this to happen because S&P told us some time ago that they would do this if the cuts weren't there. So I really don't think it's going to do a lot. In studying other countries historically and what's happened to them after they've had their credit downgrades, traditionally their interest rates haven't moved up by more than half a point, and generally their stock markets have been higher a year later.
Yeah, and Bob, what do you see happening with the financial markets going forward, say over the next 2 weeks or so? Do you think it's going to be a roller coaster ride like we've been seeing, or do you think that there are some other factors that are going to contribute to that?
Well, I think there's going to be some increased volatility, and that's a pretty strong statement given the volatility we've seen in the markets thus far. But I think most investors really aren't going to see this trickle down other than maybe drops in their portfolio as the market fluctuates. But long-term companies, strong companies with good balance sheets and clean profits are still going to be great places to invest. This has nothing to do with the ability of the companies in the United States to make money and continue to grow.
When we saw the big sell-off last week with the stock market, where did people typically move their money? What were you seeing?
Well, we were recommending FDIC insured money market funds as opposed to government money market funds where we traditionally go, just because it's an unknown. The most frightening worst case scenario obviously would be something similar to what we saw in 2008 with the mortgage market, where you have forced selling. You have endowments and a number of other entities that are required to hold only AAA securities, and it's unknown yet whether the downgrade by one agency will force that selling. If there's enough selling and no buyers, you can see prices plummet. I don't expect that it will become anywhere near that because of the full faith and credit behind the U.S. government is behind the bonds, and the downgrade's not going to impact the ability of the government to pay the debt.
AA plus is still a pretty good rating, even though it's the first time in 70 years that we've seen this from the U.S. government. Is this more of a psychological thing, do you think, or do you think Congress and the American public are going to get the message?
That's a good question. I certainly hope Congress gets the message. We've got to get our economic policy in line here and get some jobs growth and some stimulus without raising spending, and it's a difficult process because politicians are trying to take care of their constituents as they were elected to do, and it's hard to it's hard to cut. But we've got to some entitlement programs, and I think some subsidies at some point are going to have to be reduced in order to get the budget cuts we need.